Hey, what's going on, traders? Welcome to the channel. I'm John. That's my trading partner. Oh man, look at the irony of this right here. We trade options here. All right, so we are looking at a down day in the market. I'm just looking at S&P 500. You can see it here, but big topics to talk about today. AMC stock. This is potential massive short squeeze coming. Who knows? There is no guarantees in the market, but I'm going to deliver you some ways on how to prepare on an up market, down market, whatever we're thinking, and some good tools you can use, as well as I'm going to showcase my position, what I'm thinking. As always, this is not financial advice, but what I do advise you to do is hit the like button. We want to get this out to the community. It's totally free. Why not? And let's grow this community together. So thank you very much for that. Thank you for watching. Let's dive in. All right, so let's go to AMC. Let's check it out. As usual, a down day in the market. You had kind of a semi-reversal bar yesterday, and now the sentiment, you can even feel it, is lower. People are like, oh my gosh, why is it down 5, 7, 8%? And to be honest, it's not a big deal. Like, zoom out, check it out. Uptrend still intact, looks gorgeous. And also, to tie this off here, these are some things to expect. The big money likes to move the stock the way they want it. They want to play with emotions. There's a lot of psychological manipulation that goes on. And honestly, I wouldn't be surprised if we actually hit this trend line here or go below it. So as an example here, if I'm just basing off of this trend line here, check it out. We actually tested the trend line a couple times and it's like, oh, that looks good. If someone buys in and they're keeping their stop loss below the trend line, they actually like to test that and go below it. So look at that. It went lower, and then right as it kind of pushed people out of their position, the stock started shooting higher. And that's kind of what you sort of expect in plays like this. That's what you can expect from big money that likes to move the stock. And honestly, either trend line is valid for anyone. Just play it how you want. This is how I like it for my visual purposes. But I do see us potentially trading sideways to down. That's a big deal on options prices. That's something we need to talk about here. As I'll explain this, this always happens. It's like clockwork. Whenever the stock is moving higher, you see all these big moves, they shoot massively. It likes to consolidate or go lower. So whenever you see a big move, that's when people are like, oh man, I should buy, I should spend so much money on options, I should do all this stuff. And that is the worst decision ever, because what happens is when everyone is positive, things are going great, you're feeling lucky, all this stuff. Sometimes you might get lucky, you might catch the momentum as it starts going much higher, but typically the probabilities are not in your favor. And what could happen is we trade sideways. At this point, people were like, oh man, this is never going to end, we're going to the moon. And options pricing was insane expensive, and people were willing to spend $2,000, $3,000 for a contract that, as it started trading sideways right here, went basically to zero. So bear that in mind. That is really important, and it's always worth considering, as you're looking at your trades, as you're considering any position. This isn't even AMC, this is anything. And from here on out, you want to say to yourself, is this money I can afford to lose? And if it is not money you cannot afford to lose, do not trade with it. Okay, you want to use that to improve your life, do something smart with it. Make sure you can sleep at night with what you're putting at risk in the markets, always. Okay, with that being said, let's talk about the scenarios. We are in a potential scenario where we could shoot up higher, we could shoot lower. I'm going to explain kind of my strategy towards this, and there can be like different strategies based on someone's financial goals, maybe based on their risk tolerance or their expectations in the stock. So as an example, what I am doing, since I always expect kind of this sideways movement, is I do sort of an 80-20 type of principle approach to the stock. And to kind of better give you an idea on that, I'm going to go to my Tastyworks account so you can see that situation. So the 80-20 is where I own majority in shares, so about 80% or so in shares. Most of that capital is there, and there's no expiration date on the shares. They can go forever. I can sell covered calls against them. All that stuff is very beautiful. The remaining 20% does go to my speculative stuff, where it's like, hey, if this stock just shoots way higher, I've got plenty of time, let's see how it goes. And then if it goes well, it's like I'm controlling 100 shares here for about $300, $400, instead of having to spend, say, 100 shares at $47.30. That would be $4,730. So it's a little more efficient, but I'm kind of balancing the risk based on what I'm thinking. And since I can sell covered calls, if we keep trading sideways, I'm kind of collecting like an income, or basically getting these positions paid for. And that's sort of the strategy. That's the move that I like and that I'm comfortable with. And that way, if we take off to the moon, I'm positioned to take advantage. If we trade sideways, I'm positioned for it. If we trade lower, it could hurt, but I'm lessening the impact by selling premium against my shares. So that's kind of the strategy. That's the way I look at this. And as an example, if you're looking at it, say today or yesterday, let me just go to the options chain so you can look at this. So in Tastyworks, in AMC, see my AMC ticker here, and this is how you want to look at this. You see the chain of different expiration dates, and what you see on the right, it shows you the actual implied volatility of that expiration date. So for example, in 3 days, we got an upcoming expiration on Friday, the 17th. Well, this is at about 147% of implied volatility. So it's pretty high. Yesterday, it was much higher. It was like 160, 170. So you can already see, since we had a lower day drop in the market, the actual volume of the options dropped and the pricing of the options dropped from 170 to 147. So what you're seeing in that point is anyone who bought yesterday when it was like really pumped, really high, they're actually losing money now, and that can be really tricky. Always be careful on that, or be aware of that setup. But as an example, let's go to like GE, just kind of a generic stock. Well, when I go here, you're looking at 37%. So it's really low, not a lot of contracts traded. And so the premiums to buy like a call option is very, very low. You know, if I'm buying a call option a few points away from the money, it's like $38, $40. If I go to AMC and I'm looking, you know, just a couple days out and I'm a few points away, it's about $100 versus it was like $30 or $40 to buy a call there. So that gives you kind of something to understand, something to look at. The way I want to look at AMC too, let's just say I'm 31 days out to expiration. I'm going to look at like the 50 strike, right? If I think I can hit that mark, you'd pay $625 for this. But as an example, I'm going to go to the option chart so you can see how this $50 strike traded. And a few days ago, we were trading literally yesterday, 6 a.m. at Pacific time. This was trading at $1,000 for the contract. It's currently now trading at $600 for the contract. It's like a 40% difference there. That delta, that margin difference is a big deal. If we keep trading sideways like tomorrow, the next day, generally speaking, buying call options on an up day when things are pumping much higher usually is not the best idea to trade with. I also want to showcase something that's important. It's called Options Profit Calculator. It's something you can see on the website. It's totally free, just optionsprofitcalculator.com. They have Options Finder. This is kind of a useful tool. You can type in your symbol, AMC, get price. It tells you the current stock price. You can put your expected stock price. So before new highs was like $72 a share. I'm going to select that just for fun. I'll select an expiration date. I'm kind of eyeballing. Maybe I'll go to like November of this year for expiration date, and then this would be your budget for the trades. You can allocate a certain budget you're thinking. I'm gonna say like maybe $800. Let's just do that for fun. Let's see, and I'll hit long call and find options. And you'll find a couple options that you can kind of consider based on the budget, based on your expectations. But again, no guarantees in the market. And this one's telling me like, hey, if I go the November $60 call strike, I would pay $730. That's my max risk. And then my estimated potential return, if we hit that at this time, it would be $470, or basically a 65% gain approximately, which is pretty good. Other one, you can also go out, say if you went to the 65 call, you're risking less, but it looks like you'd make significantly less as well, depending on how the stock trades. So very useful tool. It's something that is worth looking at, especially if you don't have like a platform like Tasty Trade. Sorry, it's Tastyworks. I don't know why I just said that, but Tastyworks. Or if you go to, Thinkorswim, well, this was also one you can use, and you can learn like the different spreads, advanced trades, that kind of thing. So hope that was helpful. Definitely subscribe if you're new here, and hit that like. I appreciate it, and I'll see you on the next one.